If Captain America is most famous for being the first Avenger, then the Vanguard's S&P 500 Index Fund is just as famous for being the industry's first index fund. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Today, we're going to deep dive into Vanguard's S&P 500 Index Fund, also known as VFIAX. And this video is broken into 3 parts, so feel free to skip around to the sections you would find most useful. First, we'll get a good overview of the S&P 500 index. Second, we'll discuss why you want to invest in index funds, specifically in comparison to individual stocks or actively managed funds. And third, most importantly, we'll deep dive into VFIAX and understand why this is such a great fund to hold as your core equities holding. First, let's get a good understanding of the S&P 500 index. The S&P 500 is one of the oldest and most widely followed indexes in the market. It was created in 1926 when it began tracking 90 stocks, and in 1957, the list expanded to 500. And for the past century, it has been the go-to index to represent the stock market. When you turn on any financial news, reporters are always discussing how the S&P 500 is up 50 points or down 100 points. It essentially represents the 500 largest US corporations weighed by the value of their market capitalization. There's a fancy term for how finance people categorize companies based on the size of their market value. They're labeled large cap, mid cap, or small cap. As the name implies, large cap is short for large market capitalization, and it refers to companies that are valued more than $10 billion. Mid caps are companies valued between $2 billion and $10 billion. And small caps are companies valued between $300 million and $2 billion. Think up-and-coming young companies that are growing fast. Pretty much all companies within VFIAX are large cap companies. They're big boys like Apple, Microsoft, and Amazon that play a large role in our economy. Thus, any funds that follow the S&P 500 index, like the VFIAX, are oftentimes also known as large cap funds. In addition, because it's weighted by the market cap, though there are approximately 4,000 publicly traded companies in the United States total, these 500 stocks represent about 80 to 85% of the market value of all US stocks. And the weight within the index automatically adjusts based upon the changing stock prices. The bottom line is that to this day, the S&P 500 remains the standard to which professional mutual fund managers and the investment firms compare their returns against. Before we deep dive into VFIAX, let's talk a bit about why you want to invest in index funds in the first place, especially when there are so many different investing options out there, like actively managed funds, individual stocks, or other new popular investments. Number one reason is that investing in index funds mitigate individual stock risks. Many investors, especially those that are just getting started in the market, are constantly trying to beat the market. And they do this by trying to identify the winning individual stocks. Just Google hot stocks for today and you get an endless list of recommendations, all touting how their recommendation will get you amazing returns if you just follow them. However, what's most unspoken is regarding many of their bad picks. Stock pickers love to talk about their lucky picks, but like anything else in life, they rarely reveal their worst picks. Let's not forget that many of these stocks that were once on the buy now list have many turned into complete losers. Do you guys remember Blockbusters, Sears, or Kodak? Stock picking is a futile game, and it's almost impossible to pick tomorrow's winners, just as it is impossible to predict many black swan events. Index fund investing completely bypasses this individual stock risk because instead of trying to select winning stocks, index funds buy the whole index instead. Another benefit to investing in index funds is that it completely cuts out financial advisors, or sometimes called investment managers or fund managers. I have a whole video on why I don't like investment managers here, but in a nutshell, when you're working with a fund manager, you have to deal with their inherent conflict of interest. What do I mean by this? Investing can feel daunting and complex, so many people opt to work with a professional. But oftentimes what happens when you hand over your money to these so-called professionals is that these professionals aren't incentivized to get you good returns. Rather, they're just incentivized to either sell you more financial products you don't need or manage as much of your money as possible. And this is because this is how they make their money. Think about this. With your money, you want the best returns at the lowest cost. Your advisor actually wants the opposite, the highest cost, and who really cares about the returns? They just need something to have you believe that they're doing their job. And what's worse is a lot of these advisor fees are hard to identify and hidden in the crevices of your fund. It's not rare to see brokers and advisors making more money than their customers. And what's criminal is that it was the customer's money to begin with. Bypass this criminality by using the index fund strategy, like investing in Vanguard S&P 500 Index Fund, to grow your money. You'll keep more money in your pocket and out of the pockets of those who want a piece of your pie. The third benefit to investing in index funds is its exceptionally low cost. Most of us have learned with life experience that cheap may not always be the best. I mean, just visit your local 99-cent store. Few of the items there might be useful, but most of them are 99 cents for a reason. So for many things in life, paying more will often buy us better service and better quality. Therefore, it's not a surprise that many investors believe that paying for more expensive funds and more expensive investments will lead to better results. Ironically, when it comes to investing in the stock market, the opposite is true. Study after study have proven that high-cost, actively managed funds don't fare much better than low-cost, passive index funds. So by investing in simple index funds like the VFIAX, you essentially eliminate the costs associated with high-cost funds and high-cost fund managers and put more money in your pocket versus theirs. And fund costs are crucial to your ultimate portfolio returns. To give you an example of the impact of the cost, imagine if, let's say, stocks gain an average of 6% annually for the next 30 years. If you invested $250,000 with a 1% annual fee to a fund manager, you're giving away more than $350,000 in gains because of the fee. What's crazy is that this is more than the original investment of $250,000. I don't know about you, but I'd rather keep that $350,000 in my personal portfolio rather than funding someone else's pocket. But my favorite benefit to investing in index funds is that it's just so simple. Jack Bogle likes to say, simplicity is the master key to financial success. Jill Collins, one of my favorite authors, has a book titled The Simple Path to Wealth. Financial industry tries to convince us that investing is so complicated that we must buy their expensive products and services if we want to be successful investors. Well, that is just a lie. In 2020, it was recorded that there were close to 8,000 mutual funds in the market. What this means is that there are more mutual funds than the actual number of publicly traded companies in the market. Remember, there are 4,000 publicly traded companies in the United States. There's more packaging of these companies into different types of mutual funds than the goods themselves. To me, this shows that there's no shortage of financial investment companies creating new financial products and working hard to entice novice investors to buy their share-winning funds. Index funds like the Vanguard's S&P 500 Index Fund contains more stocks than most mutual funds out there. They're simple to understand and maintain, and unlike what the media likes us to believe, this investment strategy doesn't require complex mathematics, spreadsheets, and fancy financial advisors. Alright, now that you have a good appreciation for why you want to invest in index funds, let's deep dive into Vanguard 500 Index Fund, the VFIAX. The Vanguard 500 Index Fund, by design, was created to track the performance of the S&P 500 index. So what are some of its key characteristics? Let's look at its cost. When it comes to cost, the main area we want to look at is the expense ratio, a percentage of fee charged by Vanguard to maintain this fund. Vanguard is known for its low expense ratios, and for VFIAX, it is at 0.04%. This means that if you have $10,000 invested in VFIAX, you're essentially paying Vanguard $4 to manage your fund for you. They do the work of keeping your money secure, investing in appropriate security, and ensuring that your investment is tracking the S&P 500 index. Not a bad deal for $4. The Vanguard 500 Index Fund also has a minimum investment of $3,000. If you don't have $3,000 to invest, a VFIAX equivalent ETF, VOO, could be a good option. I reviewed the difference between index funds and ETFs in this video here. However, my personal recommendation is that if you can, save that $3,000 and wait to invest in VFIAX. You can't convert an ETF to an index fund, and for a long-term buy and hold investor, I personally believe index funds are all you need. Next, let's look at its composition. As stated earlier, the VFIAX is indexing the S&P 500 index. So the fund holds the 500 largest publicly traded companies, big boy companies like Amazon, Apple, and Microsoft. And due to market capitalization, the top 10 companies make up 29% of the total fund. The other 71% is made up of 490 other, still pretty big but smaller companies. Remember, VFIAX is made up of mostly large cap companies, so all companies within its funds are valued at more than $10 billion. As regards to its performance, if we're to go back to when Vanguard S&P 500 Index Fund was founded in 1975, we get an annualized average return of 11.96%. This means that if we had invested $1,000 in 1975 and held it until now, it would have grown to $210,000 today. Not bad for just buying and holding. Let's talk briefly about additional diversity in your portfolio. VFIAX is an excellent large cap fund. However, let's say that you like a bit more variety in your portfolio, such as small cap or mid cap companies. As I mentioned earlier, the 500 largest companies are all large cap companies, companies valued more than $10 billion. There are thousands of other companies in the stock market much smaller than that. And in some cases, these smaller companies have better returns than larger companies. So if you like them in your portfolio, you can add a small percentage of Vanguard's mid cap and small cap funds. This would be Vanguard Mid Cap Index Fund, VIMAX, and Vanguard Small Cap Index Fund, VSMAX. Vanguard Mid Cap Index Fund has approximately 400 mid cap companies valued between $2 billion and $10 billion. And Vanguard's Small Cap Index Fund has approximately 1,600 small cap companies. Companies valued between $300 million and $2 billion. They both have an expense ratio of 0.05% and minimum investment requirement of $3,000. Again, if you would like additional diversity in your portfolio, these will be a great addition. At the end of the day, if you like the idea of holding a well-established index fund that goes back 50 years, you can't go wrong with Vanguard 500 Index Fund, VFIAX. Thank you guys for watching. If you'd like to learn more about a few of my other favorite Vanguard funds to buy and hold forever, check out my video here. Until next time, all the best.